is Don DeBartolo, a senior commodity broker and market strategist with Daniels Trading, a division of StoneX in Chicago. I am also the trader behind the Trade Spotlight advisory service. And I like to say this is an advisory service that's broken up into three segments because I'm sending out recommendations in futures, commodity options, and future spreads. This is Beyond the Spotlight, a video that will spotlight 2 or 3 markets that may become trading opportunities for this week. This week begins with Monday, October 18th, 2021. Please pause the video and read the disclosures to understand the risks involved with futures and commodity options trading. I'm going to cover 2 charts today. One of the charts is a recommendation that's still working, and the other is a recommendation that was filled late last week, but there's still the potential to get into the trade. So I just wanted to flesh out both of these in a little more detail over video because these are 2 viable trading opportunities. The first being the March 22 sugar. Now this was a trade recommendation that I sent out September 20th. So we're going on almost a month here with no fill. But you can see from the chart here, this is the most updated chart. It's been sideways for the most part since putting out the recommendation. So at the time there was a mini double top formation. You can see that's still in play. And then there was a upper trend line that the market was staying below, and you can see that actually the price traded above that line, but we never reached those 12-month contract highs that were made as part of that double top formation. At the time, the stochastic indicator, that's a momentum indicator, was showing building downside momentum, and the trend was turning over as well. Now both are down. There's very little momentum. You can see even the turning point indicators at the bottom of the zone, and that's obvious with the sideways trading action that we've had in the sugar market. Despite those indicators being down, I still want to wait to see if there's going to be a breakout to the downside through that pivot point low that you can see as a blue ellipse. I'm working in order to sell the contract at 1930 on a stop. The stop loss to protect the position was going to be placed at 2020 above that upper trend line and the 20-day moving average. There's a risk of $1,008 plus your commissions and fees. And you can see that's still kind of in play. We could adjust it slightly for the recent highs in the last 3 days. But that 50-day moving average is 2009. So it's very close to where the stop already is working. In today's trading action, we traded as little as 1941. So we're creeping up on that 1930. So this is still a viable trade. If the market does pick up with some momentum, the target to the downside is 1680. That's near those recent contract lows. That'd be a potential profit of $2,800 minus your commissions and fees. So March 22 sugar, keep it on your radar. Have the order working. I'm not sure when the breakout will occur, especially with the market that trades early in the morning hours. The second chart is the January 22 feeder cattle contract. This recommendation was filled last week. I put the order out on the 13th, and it was filled on the 14th. You can see the futures price was starting to turn over, and I put an order out to sell on a break of a pivot point low, 160.95 on a stop, and that's sort of about where the futures price is now. So there's still an opportunity to sell this contract. You can see the following day we rallied a bit, traded down through the price to fill it. We got as low as 160.80, but then traded as high as 162.50, closing at 162.35. That was on the 14th. It didn't take out the previous high, so obviously still in the position. And then the last couple sessions, we've enjoyed some sell-off here back to where we entered the position. And I believe there's more to come. If you look at those indicators, strong downside momentum, looking at the stochastic indicator, the trend is down. Looking at the MACD indicator, the turning point indicator showing it's just crossing over the middle 50. We're at 37 right now, so that has strong downside movement, I believe, still to come. The initial stop loss is working at 163.15 above the high from last week and the 50-day moving average. That's a risk of $1,110 plus your commissions and fees. And the target is at 155.80 near that lower congestion level, which is a profit of $2,575 minus your commissions and fees. So if you get this video and watch this, take a look at the price of feeder cattle. If it's still right there, I recommend selling this contract with the stop and target that I have listed. But of course, you can always alter to fit your trading style. This is what the email service looks like. So you would have seen this for sugar, for feeder cattle. I've got a write-up of the trade, the entry and exit orders, so you know the risk-reward parameters, any important information like margins or days till option expiration, and a chart that you can click open to view larger. If you're not following the Trade Spotlight, I encourage you to do so. It's a free service to all. Just go to the Daniels Trading webpage, danielstrading.com. At the top, you'll see tabs. Click on Advisories, and under Technical Analysis, you will find the Trade Spotlight. You can read more about it, see recent posts, and click the orange button to subscribe. Here is all my contact information if you have any questions on these particular recommendations or just the markets in general. Thank you for taking the time to watch and listen, and happy trading.